Hey everyone, welcome back to Corporate Decoder, the place where we try to find the hidden gems in these corporate filings. And let me tell you, Ranger Energy Services has some interesting pieces in their latest report, especially when it comes to how they are navigating the oil and gas world. This report, a 10Q filing, gives us a really close look at Ranger Energy Services' financial health for the period ending the 30th of September 2025. It's like peering under the hood of their business operations and finances. Stick around because we dig into what these numbers actually mean for the company and what risks and opportunities lie ahead. And hey, if you like getting these kinds of insights without the jargon, make sure you hit that subscribe button. We also have a growing community over on Discord, linked in the description, where we break down more of these filings. Alright, let's get straight into it. This document is essentially Ranger's report card for the third quarter of 2025. It tells us how they are doing financially and what challenges they might be facing. First up, revenue for the 3 months ending the 30th of September 2025. Ranger brought in $128.9 million. Now that might sound like a lot, but it's actually a 16% drop compared to the same time last year, which was $153 million. That's a pretty noticeable dip. Let's break that down. Their high specification rig segment, which sounds pretty important, saw revenue fall by 7% to $80.9 million. They explain this is because the price they could charge per rig hour went down a bit, and they also used their rigs for fewer hours. The wireline services segment took a much bigger hit. Revenue dropped by a whopping 43%, down to $17.2 million from $30.3 million last year. This is mainly because fewer clients needed their services for well completions, and companies also cut back on other services like production and pump down. Their processing solutions and ancillary services segment also saw a decrease, down 14% to $30.8 million. This was due to a drop in demand for coil tubing, snubbing, and logistics services. It seems like clients were really scaling back on spending, especially when oil prices started to look shaky. So, with revenues down, it is no surprise that their bottom line net income also took a significant tumble. For the third quarter of 2025, they reported a net income of just $1.2 million. That's a massive 86% drop from the $8.7 million they earned in the same period last year. This means that for every dollar earned, they are keeping a lot less than they did before. Looking at the longer 9-month period tell a similar story. Total revenue for the first 9 months of 2025 was $404.7 million, down 5% from $428 million in the same period last year. The high specification rig segment actually saw a small revenue increase of 2%, bringing in $254.7 million. This was thanks to a slight increase in the average price per rig hour and a bit more rig time utilized compared to last year. However, the wireline services segment continued to struggle, with revenue falling by a significant 36% to $56.5 million. They attribute this to lower demand for completion services, with fewer stages completed. This segment seems to be really feeling the pinch of reduced activity. Processing solutions and ancillary services revenue saw a modest 2% increase, reaching $93.5 million. This growth was driven by increased activity in rentals and coil tubing services, as well as their torrent gas processing business. However, this was partly offset by a decrease in plugging and abandonment services. For the 9-month period, net income was $9.1 million, a decrease of 28% from $12.6 million in 2024. This confirms the trend we saw in the quarterly results, with the wireline segment struggles significantly impacting overall profitability. Now let's talk about adjusted EBITDA, a measure that companies often use to show their core operating performance. For the third quarter of 2025, their total adjusted EBITDA was $16.8 million. This is a pretty significant drop from $25.1 million in the same quarter last year. This indicates that the core business operations are generating less profit. For the 9 months ended the 30th of September 2025, total adjusted EBITDA was $52.9 million. This is down from $57 million in the same period last year. Looking at this by segment for the 3 months, the high specification rig segment's adjusted EBITDA fell to $15.7 million from $19.2 million. This is mainly because revenue dropped, and while costs also went down, they did not fall as much. The wireline services segment's adjusted EBITDA also fell, down to just $0.4 million from $2.7 million. This segment is really feeling the pressure, with revenue declines significantly impacting its profitability. For processing solutions and ancillary services, adjusted EBITDA decreased to $5.5 million from $8.8 million. Again, revenue was down, and costs didn't decrease as much. Scroll of the adjusted EBITDA $4.8 center the other category. which usually includes corporate overhead, saw their loss improve to $4.8 million from $5.6 million, which is a positive sign in that area. When we look at cash flow, net cash provided by operating activities for the 9 months ending the 30th of September, 2025 was $44.9 million. This is down from $51.8 million in 2024. A key reason for this decrease was a bigger cash outflow related to managing their working capital, like accounts receivable and inventory. In terms of investing activities, they used $17.5 million in the first 9 months of 2025. This is less than the $27.2 million used in the same period in 2024. This likely means they are spending less on things like new equipment or property. Financing activities show they used $23.1 million, which is also less than the $25.5 million in 2024. This difference is partly due to them buying back fewer shares of their own stock in 2025 compared to last year. Looking at the balance sheet, total current assets on the 30th of September 2025 were $147.2 million, a slight increase from $143.9 million at the end of 2024. This means they have a bit more in short-term assets like cash and receivables. Accounts receivable, which is money owed to them by customers, increased to $74.1 million from $68.4 million. This could mean they are selling more on credit or that it's taking longer for customers to pay. Their property and equipment, after accounting for wear and tear, decreased to $214.9 million from $224.3 million. This is consistent with them spending less on new equipment as seen in their investing activities cash flow. On the liability side, total current liabilities decreased to $59.7 million from $65.2 million. This is a good sign, indicating they have reduced their short-term debts or obligations. The deferred tax liability went up to $21.8 million from $18.2 million. This can sometimes happen when a company is profitable and expects to pay more taxes in the future. Stockholders' equity, which represents the owner's stake in the company, decreased slightly to $270 million from $273.8 million. This decrease is mainly due to share repurchases and dividends paid out. They also mention their class of common stock having a $0.01 par value and 100 million shares authorized. As of the 30th of September 2025, they had over 21 million shares outstanding. Interestingly, they hold a significant number of their own shares in treasury, almost 5 million shares. This is often done when a company buys back its own stock, reducing the number of shares available to the public. Now, let's talk about the risks. They have a section on risk concentrations, which is a polite way of saying they rely heavily on a few big customers. For the third quarter of 2025, just 3 customers accounted for about 27%, 24%, and 12% of their total revenue. That's a significant chunk of their business tied to a small group of clients. One of the most significant things that happened after the reporting period is an acquisition. On the 7th of November 2025, Ranger announced it was buying American Well Intermediate Holdings LLC, which operates high-specification rigs primarily in the Permian Basin. The deal is worth about $90.5 million, including cash and their own stock. This shows they are actively looking to grow through acquisitions, especially in key oil-producing regions. Before we wrap up, it's important to remember that this report contains forward-looking statements. These are essentially educated guesses about the future. They mention that actual results could be very different due to a whole list of risks. Some of these risks include potential cuts in spending by oil and gas companies, which directly impacts demand for their services. Oil and gas price swings are also a big concern, as they affect how much their customers can afford to spend. And of course, competition is always a factor, including pressure on prices. They also highlight cybersecurity risks, which is a growing concern for any modern business. Interest rate increases are also a risk, especially with their credit facility. They openly admit that liquidity and access to capital could pose challenges. This suggests that if business conditions worsen, they might struggle to get the funds they need. So, what's the story here? Ranger Energy Services is clearly operating in a tough market. Their revenue and profits have declined, especially in their wireline services segment. While they made a strategic acquisition to boost their high-specification rigs business, the overall picture suggests they are feeling the squeeze from lower oil and gas activity and increased competition. The drop in revenue and profit, along with the increased reliance on a few large customers, raises some concerns about their stability. However, the acquisition shows ambition and a strategy to consolidate and grow. The fact that they are also buying back their own stock and paying dividends shows a commitment to returning value to shareholders, but this must be balanced against the need for operational capital. Looking at their performance, it seems like they are proactively managing costs. But the market conditions are making it difficult to maintain historical profitability. The increased use of adjusted EBITDA suggests they are trying to highlight operational performance despite the broader financial picture. In conclusion, Ranger Energy Services is in a challenging part of the oil and gas cycle. Their efforts to diversify and acquire assets are a good sign of a forward strategy, but the decline in revenue and profit, particularly in a key segment, needs careful watching. It's a company navigating a turbulent industry with both potential for strategic growth and significant market-related risks. Alright, that's our breakdown of Ranger Energy Services' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.